Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
Good morning. You know, usually we look at the markets, everything it kind of moves in a herd.
Yeah.
But today feels like we're watching two completely different movies on the exact same screen.
It really does. It is Thursday, February 26, 2026. And if you scan the headlines we've pulled for this deep dive today from Bloomberg, Reuters, CNBC, and Yahoo Finance, you just get this sense of extreme vertigo.
Extreme, yeah.
Because on one side, you have the tech giants posting numbers that are frankly historic. And then on the other, you have traditional heavy industrial titans, specifically in automotive, just stumbling in a way we haven't seen in decades.
Fire and ice out there.
Exactly. So our mission today is to synthesize this massive stack of earnings reports we have. We've got NVIDIA, Salesforce, Stellantis, plus some really intense geopolitical updates involving Iran, global trade tariffs, and commodities like gold and oil. We want to answer a single question for you today. Are we in a boom, a bust, or just a really painful, messy transition?
I mean, that is the question of the year. Because depending on where you look in these reports, you can find hard evidence for all three of those scenarios.
Let's start with the boom then, the juggernaut. The company that literally seems to be holding the entire S&P 500 on its back right now, NVIDIA.
Right.
They reported fiscal Q4 earnings, and look, we all expected a beat. Everyone expected a beat. But did they really deliver this much?
I think deliver is probably too soft a word. According to the reports we pulled from CNBC and Yahoo Finance, NVIDIA didn't just step over the bar, they completely vaulted it.
They really did.
They reported revenue of $68.1 billion for the quarter. And context is key here for you listening. Wall Street was looking for roughly $66.2 billion. Earnings per share came in at $1.62.
Which is massive, just huge. But here is the thing that really stood out to me when I was digging into the data. It wasn't just the rear view mirror stuff. It was the windshield. The guidance for Q1 is just, it's aggressive.
It's staggering, honestly. They are projecting Q1 revenue of $78 billion.
$78 billion.
Yeah, plus or minus 2%. The consensus estimate, what the smartest analysts on Wall Street thought was the best case scenario, was only $72.6 billion.
That is over a $5 billion gap in expectation.
Exactly. And the catalyst here, which CNBC highlighted in their breakdown, isn't just more of the same chips. It's the new hardware.
Right, the Vera Rubin AI super chip. We've been hearing rumors about this architecture for, what, over a year now?
A long time, yeah. And it started shipping in Q4. This is the next major evolution after the Blackwell chips. And apparently the demand isn't just high, it's totally insatiable.
Because it's faster, right.
Faster, way more energy efficient, and it's effectively forcing every single major data center out there to either upgrade immediately or just get left completely behind.
But, and this is the part that I found fascinating reading the Yahoo Finance analysis, the stock reaction was weirdly muted. It was up maybe 1% in pre-market trading.
Yeah.
You beat guidance by $5 billion and the market just shrugs. Explain that disconnect.
Well, it is the phenomenon of the moment right now. Analysts are calling it the AI scare trade, or sometimes the infrastructure bubble fear. See, for the last 3 years, the only question that mattered was just, can NVIDIA make enough chips?
Supply was the only bottleneck.
Right, but now, the bottleneck is shifting to the wallet. Investors are looking at this and asking if the spending on these chips is actually sustainable. You have these massive hyperscalers, Microsoft, Meta, Google, buying billions of dollars of hardware. But are they making money from it yet?
Right. There is this growing fear that we are building a massive gold-plated railway for a train that hasn't even arrived yet.
Precisely. It's ROI anxiety, return on investment. And that anxiety isn't staying contained. It's bleeding over into the software sector. Which brings us right to Salesforce.
Let's unpack that, because while NVIDIA is posting these record numbers, Salesforce is effectively sitting in the penalty box today.
Very much so.
Shares are down about 4% in pre-market.
Yeah.
And there is this narrative floating around out there that software goes to zero.
It's a really provocative thesis, but it's gaining some serious traction. The idea is simple. If AI gets good enough, you don't need big, complex SaaS platforms anymore.
You don't need a human to navigate a complex dashboard.
Exactly. You just have an AI agent do the work for you. And if the AI agent is doing all the work in the background, do you really need to pay for a $100 a month Salesforce seat license for a human employee?
That cuts right to the core of their entire business model.
It does.
But Jensen Huang, NVIDIA's CEO, he pushed back on this, didn't he? I saw a clip from his interview on CNBC where he seemed surprisingly defensive of the software guys.
He was very defensive. He argued flat out that the market has got it wrong. His view is that AI agents aren't replacements, they're tool users.
Tool users.
Yeah. He explicitly mentioned platforms like ServiceNow, SAP, and Cadence. He thinks AI will actually make these platforms more valuable because the AI needs a structured environment, a database, a rigid workflow to actually operate within.
So in his view, the AI is the pilot, but Salesforce is still the plane. And you still need to buy the plane.
That is the bull case. But right now, looking at the tape, the market just isn't buying it. Salesforce grew revenue by 12%, which is perfectly decent in a normal world.
Sure.
But their fiscal year 2027 guidance came in a bit light. They projected between $45.8 and $46.2 billion, and that missed expectations.
And we all know when growth slows in software, investors just get ruthless.
They really do. And that's exactly why Mark Benioff, the CEO of Salesforce, is pulling the emergency lever today. He announced a massive $50 billion buyback program.
$50 billion. That is just a staggering amount of capital to deploy.
It is. And for you listening who might not be deep into corporate finance mechanics, when a CEO authorizes a buyback that large, he's effectively doing two things at once. One, he's manufacturing earnings per share growth by simply reducing the number of shares available.
Right.
But two, he is shouting to the market, my stock is too cheap. He's using the company's own cash to put a hard floor under the stock price because the market simply doesn't believe the organic growth story anymore.
It's a defensive move, so we have tech fighting this huge narrative battle right now, hardware versus software.
Yep.
But let's pivot over to the old world economy. Because if tech is dealing with existential, philosophical questions, the auto industry is dealing with a very literal financial car crash.
It is a brutal scene today. We are talking about Stellantis, the parent company of Jeep, Dodge, Fiat, Chrysler. This is a massive, sprawling industrial conglomerate.
And according to the CNBC reports, they just posted their first ever annual loss since the merger that created the company.
Right. And looking at the numbers, this wasn't just some accounting rounding error loss.
No, not at all.
We are talking about a net loss of 22.3 billion euros for 2025.
Wow.
Compare that to a 5.5 billion euro profit the year before. That is a negative swing of nearly 28 billion euros in a single year.
That is so hard to wrap your head around. How does a company that established lose that much money that quickly?
Honestly, you admit you were completely wrong. The bulk of that massive loss comes directly from write-downs. Specifically, a 25.4 billion euro write-down entirely related to their electric vehicle strategy.
Let's define that for a second so everyone is on the same page. A write-down in this specific context basically means they looked at their physical factories, their custom tooling, their R&D for EVs, and finally said, these assets are simply not worth what we thought they were.
Correct. It's an admission that the money spent is already gone and will never generate the returns they originally planned on. And the CEO, Antonio Filosa, was surprisingly candid about it on the call.
What did he say?
He outright admitted to overestimating the pace of the energy transition.
Overestimating the pace. I mean, that feels like the defining quote of the day for the entire legacy auto industry.
It really does. Because it's not just Stellantis acting on this. The reports mention Ford, GM, and Honda are all rapidly walking back their aggressive EV timelines, too.
They are realizing that while the future might absolutely be electric, the present is still very much hybrid and gas-focused.
Right. The consumer just isn't showing up for pure EVs at the speed that government mandates and corporate boardrooms predicted they would.
And the consequences for shareholders here are very real and very immediate. Stellantis suspended their 2026 dividend.
Which is the ultimate red flag for income investors. You hold legacy auto stocks specifically for the dividend. When that goes away, your entire investment thesis breaks.
It signals that cash preservation is now infinitely more important to them than shareholder returns.
Exactly. It's a complete and total reversal from the blind optimism we saw in this sector just 2 or 3 years ago.
Okay, so we have the future economy of AI chips growing massively, but facing ROI skepticism. And we have the past economy of autos just crashing into hard reality.
Yeah.
But I want to look at where the growth is actually happening geographically. There was a really fascinating scoop in Bloomberg and Reuters this morning about Apple.
This one connects directly to the global search for new growth engines. Apple is in active, advanced talks to launch Apple Pay in India.
Now, for listeners who don't follow the Indian fintech market closely, why is this such a big deal? I mean, Apple Pay is everywhere here. Why has India been such a hard nut for them to crack?
Because India basically leapfrogged the entire credit card era. They built something called UPI, the Unified Payments Interface.
Right.
It is a state-backed, real-time payment system that connects banks directly to each other. It's QR code-based, it's completely instant, and crucially, it has 0 transaction fees for the user.
And Apple usually likes to come in, use the existing Visa or MasterCard credit card rails, and take a small slice of every transaction fee for themselves.
Exactly. That's their whole services model. And in India, that model just fundamentally does not work because UPI dominates everything, from street vendors to luxury stores.
So if you want to do digital payments in India at all, you must play nice with UPI.
You have to. You can't just come in with a Western credit card infrastructure and expect to win. So Apple is effectively capitulating here. They are adapting their closed ecosystem to fit the open Indian infrastructure.
The Reuters report actually names specific banking partners they are talking to: ICICI Bank, HDFC Bank, Axis Bank. This sounds like a real full-court press by Apple.
Oh, it is. And the timing is really the key piece of the puzzle here. The Reserve Bank of India recently changed their rules to officially allow biometric authentication, things like Face ID and Touch ID for payments.
Oh, interesting. What was it before?
Before this, regulations often required a one-time password sent via text message for every single transaction.
Which completely ruins the Apple magic of just a seamless 1-second tap.
Exactly. It adds too much friction. So this regulatory shift paves the way for that smooth Apple Pay experience, but it's going to be built entirely on top of the Indian banking rails.
And the broader strategic goal here is pretty obvious, right? It's diversification away from China.
100%. Apple currently has only about a 10% smartphone market share in India. But India is the world's most populous country now, with a rapidly rising tech-savvy middle class.
They see India as the next China, a massive, untapped lever for growth, both for selling physical iPhones and for driving that recurring services revenue.
Right. And they are targeting a launch by the middle of this year, 2026.
Which naturally brings us to the real elephant in the room today, the global macro environment.
Yeah, I had to talk about it.
Because while all these individual companies are making these micro moves, launching payments in India, buying back $50 billion in stock, the macro ground beneath them is violently shifting.
It really is.
I'm looking at the commodities charts from Bloomberg right now, and gold is, well, it's behaving like the world is ending.
It is absolutely skyrocketing. Gold is trading near $5,200 an ounce this morning. It's up nearly 20% in 2026 alone.
$5,200. I mean, I remember when $2,000 felt like an unbreakable psychological barrier. Why the sudden rush to gold? Usually gold only rallies like this when the dollar is super weak or inflation is running out of control. What's the main driver today?
It's what analysts call the wall of worry. It's not just one single thing. It's the convergence of 3 very different, very real fears.
Okay, let's break them down.
First, you have the Federal Reserve. We have a retiring Fed president, Raphael Bostic, writing these farewell essays that are surprisingly alarmist. He's worrying openly and publicly about political interference in the central bank.
And investors hate that. The market wants the Fed to be boring, predictable, and totally independent.
Exactly. If the Fed becomes a political tool, the fear is that inflation fighting takes a back seat to election cycles. That immediately devalues the currency in the eyes of the world, and that drives people straight to gold.
And then there is the geopolitical tension, specifically what we're seeing in the energy markets today.
Right. Oil is hovering around $71 for Brent crude, which on paper doesn't seem aggressively high, but the market itself is incredibly tense. There are major U.S.-Iran nuclear talks happening literally today in Geneva.
And the backdrop for those talks is pretty toxic. The U.S. just sanctioned 30 different entities tied to Iranian oil and weapons yesterday, right?
Yes. And if you look at the physical data coming out of the region, this tells a scary story. Saudi Arabia is currently exporting its highest crude levels in 3 years. They are pumping and selling while they can.
But the really scary data point from the Reuters piece is that Iran is actively filling up their oil tankers and just leaving them anchored, floating storage.
Yes.
What does that actually signal? Why fill a massive tanker just to let it sit in the ocean?
It almost always signals preparation for a major disruption. Either they anticipate new, harsher sanctions, completely blocking their export pipelines soon, or they are actively preparing for a conflict where they might need those reserves or need to use their dark fleet logistics network.
So the oil market is currently just frozen. Everyone is holding their breath, waiting to see if these Geneva talks produce a handshake or a door slam.
Exactly.
And then, just to add one more heavy layer of chaos onto the pile, We have the trade situation right here in the U.S. We have a Supreme Court ruling that just threw a massive wrench into the entire tariff regime.
This is a legal mess that has instantly become a global economic mess.
Right.
The Supreme Court struck down President Trump's previous tariffs that were based on the IEPA, that's the International Emergency Economic Powers Act.
Because the court basically said you can't use national emergency powers for standard, everyday trade disputes. It was executive overreach.
Right, so the court struck them down.
So those tariffs are just gone.
Well, no, because this is whack-a-mole policymaking at its finest. Trump immediately pivoted to a completely different law, the Trade Act of 1974.
Okay.
And under that act, he imposed a 10% universal tariff on everything, and he is actively threatening to raise it to 15%.
But didn't we just spend years getting specific trade deals in place? I saw a note in the Bloomberg brief about Japan and India scrambling this morning.
That's the source of the chaos. Countries made massive concessions just to avoid the old IEPA tariffs. Now that the Supreme Court says those old tariffs were illegal, do those negotiated deals still hold? Or does this new 10% universal tariff apply to absolutely everyone, regardless of any previous handshakes?
Wow. So if I'm Japan, I'm sitting there saying, wait a minute, I paid a heavy price in negotiations to avoid a tariff that was just ruled illegal, and now I'm getting hit with a brand new 10% tariff anyway.
Exactly. Japan's trade minister is frantically urging Washington not to treat them less favorably today. And India is in the exact same boat. In fact, Howard Lutnick, the Commerce Secretary, is physically in India right now.
Oh, the timing on that is incredible.
The reports say he is on the ground trying to figure out if their previous deal, where India agreed to lower their tariffs to 18% on certain U.S. goods, is even still valid under this new framework.
It sounds like the fundamental rules of the global economic game are just being rewritten in real time on a Thursday morning.
And markets absolutely hate that kind of uncertainty. Which brings us right back to gold. When you don't know if your multi-billion-dollar trade deal is valid, or if the Fed is independent anymore, or if a physical war is starting in the Middle East, you don't buy growth stocks. You don't buy corporate bonds.
You buy gold.
You buy gold.
So let's try to synthesize all of this for you listening. We covered a massive amount of ground today.
We did. And if we step back and look at the whole board, I think we are clearly seeing a changing of the guard, but it's happening in a really thick fog.
Right.
Capital is flowing aggressively into the tools of the future, like NVIDIA and AI infrastructure. Even though the broader market is terrified that it's an infrastructure bubble, it's a hold-your-nose-and-buy situation because the numbers are just too big to ignore.
And simultaneously, capital is fleeing the infrastructure of the past. Legacy automakers like Stellantis, who clearly misjudged the transition speed of the consumer, they bet tens of billions on a future that hasn't arrived yet, and they got severely punished for it today.
Right. And in the background of all that corporate drama, the fundamental geopolitical framework that held global trade together, stable tariffs, predictable central banks, is fracturing.
That's why you see Apple trying to build a brand new fortress in India, totally independent of China and the U.S. trade wars.
And it's exactly why institutional investors are hoarding gold at $5,200 an ounce. Everyone is just trying to hedge against a global transition that is moving faster and far more chaotically than anyone's models predicted.
It really challenges the whole idea of business as usual. You know, looking at the contrast between NVIDIA and Salesforce today, that really sticks with me.
It raises a very provocative question for investors, doesn't it? If the AI scare trade is real, if people are genuinely worried that AI isn't going to be profitable, why is the demand for the physical hardware accelerating while the software companies struggle so much?
Yeah, why?
Are we just seeing a standard tech bubble?
Yeah.
Or are we seeing a fundamental shift in capitalism where the actual value in the economy is permanently moving away from the platform, the place where humans do work, to the tool, the thing that actually does the work for you?
Because if AI agents really do become the new digital employees of the world, maybe the software dashboards they use just become a cheap commodity.
Exactly. And the silicon chips that run those agents become the only thing that actually matters.
That is a thought that will definitely keep some software CEOs up at night, I'm sure. Mark Benioff certainly has his work cut out for him with that $50 billion buyback.
He certainly does.
Well, that is all the time we have for this deep dive today. A lot to digest, from the dizzying heights of the AI boom to the messy realities of global trade and legacy autos.
Definitely a Thursday for the history books.
We'll see you all tomorrow morning with new headlines from major financial magazines.